Welcome back to the Investor Blueprint. I'm really excited today. Me and Reggie are here, and we have a visitor. But we're going to be bringing a live, active multifamily unit out of Oakland County onto the chopping block today. We're going to see if it's a good deal or a bad deal. But we got a lot of things to talk about. How you doing, Reggie?
I'm doing great, and I'm really excited. We've got an incredible guest with us today, and I'm so excited about it because she is the reason why you and I even know each other, Charlie.
Yes.
She brought us together.
Absolutely.
And we had lunch in downtown, and it was great. And that's kind of where everything kind of kicked off. So it is my honor, and I've known Carol for a long time.
Very long time.
Probably, I don't know, 15 16
plus years.
Yeah,
Yes,
absolutely.
yes.
In my prior life,
Yes.
before the mortgage industry.
Right.
We were just talking before, you've been in the real estate world for multiple decades. Let's just say
over
that.
4 decades, and we'll leave it at that.
But she is a wealth of knowledge. She's with Liberty Title.
Yep.
And we're so excited to have her here because most of the time people think title insurance, what is it? Is it really necessary? It's boring, blah, blah, blah. But there's some key information that I think we're going to dive into today, and general questions that I have, and I know a lot of our viewers are going to be curious about it as well. So, Carol, welcome to the Investor's Blueprint.
Welcome.
We're so excited to have you, and just like a quick little intro about yourself, and that way people can
it's a
kind of get to
pleasure
know
to
you.
be here. Thank you both. It's funny. I normally don't get people together and introduce them to each other. I'm terrible at introductions. I've been working really hard for 40 years trying to get better at it. But I've known Reggie. We've known each other for a very long time. We've been friends for a long time. I was a member at your last business. And Charlie, we're newer acquaintances. But when I met Charlie, I immediately thought, because you were into social media and doing different things for promotion of your business and trying to get information out to people, I thought, wait a minute, I think the two of you would would be able to work really well together. And it seems like I was right, and I'm not always right. So it was kind of nice I was right about that. So yeah, my name is Carol Bullion-Mincy. I started in the housing industry in 1984. So a long time. I've kept my license for forever. I actually started in real estate, as a real estate secretary. And we used to, put together documents by hand. We had a calculator doing it. There was no fax machine. There was no internet. So quite a while ago. But then I got into title insurance, owned my own title company for about 10 years, and then sold it to Liberty. Prior to that, I worked for a large underwriter as President Stewart Title. And I'm very, very active in my field. So one of the things that was important to me, because I was a mom, I had a family that I helped, support, was if I'm going to be gone every day, all day at work, I'm going to learn as much as I can about it, right? I want to be the best at what it is. And I don't know that I'm the best, but
you're right up there.
But I really enjoy it. I do a lot. I do a lot of, I help people get things done. So if there's a difficult transaction, or if there's someone fighting it, maybe it's a bad divorce, maybe it's a difficult situation with an estate, or someone has passed away, a lot of times I'm called into that to try to, work the things, smooth things out, and get it done. So I love the industry. It's a part of who I am, but I'm very, very pleased to be here.
And you've given so much to the industry too, because you've taught a lot. You teach a lot of classes, active.
I do.
And you're super involved with the local real estate board.
Yes.
And
our state association, I do a lot for our so I also, with American Land Title Association, I sit on the legislative committee and the education committee.
Yeah.
So part of that included me writing the ethics program for American Land Title Association. Now, I wrote it and took it back to our committee, but that was a while ago when, our industry in the mid-2000s was under attack for not having a really good ethics program. So I'm like, okay, we have to fix this. And we did. So, I'm very, very a strong believer in, the public needs us to be on our game to protect them, their interests, their rights, their money. And I take that very, very seriously. And I know both of you do as well. So that's why I'm very
and
happy
even
to be
with
here.
continuing education classes and helping develop that within the state.
Yes,
You've been critical with that as well.
Aw,
So
yes, well, thank you. I really enjoy
awesome.
teaching because, as you will both agree, when you're new to the industry, everyone usually has a couple people that mentored them.
Yeah.
I was very fortunate to have very incredible people, actually, that were mentors, and I try really hard to bring the people that are new up with that as well, because that's how we all learn and grow at the end of the day.
Absolutely. Absolutely. So the theme of this podcast is obviously the investor's blueprint, right? So our focus is around investors and really helping them.
Yes.
Now, I guess, so if, just some common questions that a lot of people might have, you hear things like, a 1031 exchange is very common in the investor world.
Yes.
Right. So can you explain a little bit about the 1031 exchange? What is the title's role in that?
Absolutely.
And then just we'll go from there.
Yes. So a 1031 exchange, in my opinion, is crucial for taxpayers to save money. And at the end of the day, if you have an investment property and you want to sell it because your eyes are on something else, whether you want to go from like a duplex to maybe an apartment building, whatever it is, if you sell it and then close and take receipt of that money, and then you turn around and buy the other property, you now just have a problem with capital gains. Like, that is automatically the proceeds you take are going to be taxed at the level that you are going to pay. And so the Internal Revenue Code came up with this wonderful 1031 exchange, where as long as you don't take the receipt of that money, those proceeds, as long as it's put into a separate entity, which is a qualified intermediary, right? And we'll talk about that later on. As long as someone else holds it and you don't use that money, and you use all the guidelines under the code, and we'll talk about that, I'm sure, as well, then you can just have that money transferred right into the new property without paying capital gains on it at all.
Yeah,
which is fantastic. And
Huge.
it's a lot of money. It's a lot of money.
Yes.
So I've used a 1031 exchange myself.
Yes.
So we have had rental properties.
Now, and there's timelines on that, obviously.
Yes.
So you have to do it fairly quickly. I
Right.
think it's within 45 days.
So you have to, So when you decide to go with the 1031 exchange, you have 45 days to identify the property or properties that are going to be replacing the one that you're selling.
Right.
Then you have 180 days to actually close on, not just, we've got to. Extensions are usually not given in a 1031 exchange. You've got to be very careful with that because the rules are very specific.
Yeah.
But as long as you meet those criteria, then you're able to move that money without it being subject to the capital gains.
So talking about that a little bit, so you identify a property within those 45 days.
Yes.
You start the inspection and it doesn't work out. Now what?
Well, so they do have, so what's really cool about 1031 exchanges, and it changes every now and again, but there's a couple different ways. I know people that will identify one property. There's also something called the 3-property rule, just for that reason.
Right.
Because if your 45 days don't start with each property, it starts from the time
of sale.
Absolutely. It starts, clock is going. So there's the 3-property rule, or there's the 200% rule. So the 3-property rule is you can identify up to 3 properties for that reason. Maybe, 2 of them, the contractor's inspection was bad, or maybe it's not financeable, or whatever the issue is. You now have other properties that you can do at the same time. So you're not starting back at square one on day 24, right? It's because then it's going to be really difficult to do what you need to do. The 200% rule, you can identify as many properties as you want, but the value of those properties cannot be more than 200% of the property you're releasing, right? Or the property you're selling.
Gotcha.
So that is why. So yes, that happens on a regular basis.
Right.
The Internal Revenue Service recognized that, and then they brought different options to the investor, to the taxpayer, to help them offset that. Now, we've got another property ready to go. So
when you say 200%, you're talking about each individual property itself. It's
together.
not like the cumulative.
It's together.
It is the cumulative.
Yes.
Wow.
Yeah.
Okay.
So you have to be really careful with that.
Yeah,
so
that'll
people
handcuff you really
usually do I've seen the 3.
The 3.
I've seen, the three
Right.
property rule. I've seen way more than the 200%.
I don't believe that I've ever seen the 200%. So,
Okay. Yeah, I was going to
yes.
say. Yeah.
No. And that's why I'd ask. I've never
Right.
seen the 200%.
Interesting.
Right.
So does the title company hold that in an escrow account?
No.
Or?
So thank you for asking.
Yeah.
So that we talked about qualified intermediary,
Yep.
and that now the rule says it can be just a disinterested party in the transaction, but I would say don't. That's again another internet thing. I would say absolutely not. You really want to work with a qualified intermediary. A lot of times it is an attorney.
Okay.
That specializes in this because you have to know the rules, and there's inside out, up and down. You have to know the documents that have to be generated. You have to know all the timelines and what your part is in it. So it's usually an attorney, or I actually have found and work with a company, and they're out of California, and they have been wonderful to work with as well. And that's all they do. And I think it's 1031 nationwide. And I just wanted to try it and, to see, okay, what, because I do work with attorneys on these, but I really will tell you, it's been phenomenal. It is complete process for them. They are very timely. Because remember, documents have to be generated for that closing, right? Because you can't do a 1031 exchange after you've done your closing.
Right.
And I will tell you, one of the nice things, and one of the things that, people listening to us, if they're going to go that route and they decide to get their own QI, qualified intermediary, is finding out how much notice do they need.
Yeah.
Like, I will tell you, the company I work with in California, if we're closing tomorrow, and we find out right now that the seller says, hey, by the way, I want to do a 1031, they've been able to get the documents
Wow.
together.
Oh,
It takes
geez.
a little bit
Okay.
we don't encourage
Recommend
that,
that.
but we don't encourage it because you want to make sure things are not done quickly, right, or rashly.
Right.
But it's wonderful because it's a whole packet of information, and they need a lot of information there. So it can be done pretty quickly. But the qualified intermediary is the most important piece of a 1031 exchange because they're the ones that are making sure the documents are correct. They're the ones you're going to be working with for the replacement property, and the closing. They're going to be holding your money. They're going to be transferring the money when you buy that replacement property. So it's really important that you feel comfortable with that QI that you pick.
Yeah. And see, this is the important stuff that I think a lot of people don't understand how it really works, because if it touches your bank account, like let's say you close, you get a check from the title company, and then the next day you decide, oh, by the way, I'm going to do this, or what's this 1031 exchange? Somebody was telling me about it.
No.
It's too late.
It is way too late. And
Yes.
any part of the money you touch
Right.
is taxable. The minute you touch it, it's taxable.
Yeah. Yeah, absolutely.
And the company that you use or that you've been talking about in California, or any of these companies out there, there's a charge. It's not a huge charge though.
No.
But it's still protecting you. The taxes that you would be paying are
Right.
exorbitant. So, but
Well,
there is a charge.
Some of the attorneys would charge a very common cost is around $1,200 for the first purchase where they're taking the money in and holding it,
Right.
because that's the lion's share of generating the documents, getting them signed, following
Sure.
all the rules, and then usually like a $500 or $600 charge on the replacement property piece. But I will tell you, the company I use, I want to say it's under $695 for the entire transaction, both pieces.
Okay.
And I was trying them to see, okay, what is this going to be like? I don't know anything about them. And everyone I've worked there has been very professional, and they have done a great job.
That's great. That's great. So, kind of moving away from the 1031, another big thing that a lot of people look at is closing in an LLC.
Yes.
Now, on a mortgage side, that's definitely possible through, the DSCR loans and whatnot. And we can talk about the pros and cons of that. But as far as a title goes, there's a couple different ways that you can close, whether it's personally, like if I'm buying a house, do I buy it under Reggie Osborn just as an individual, or do I want,
YVF Incorporated or whatever.
Yeah,
Right.
some investments or whatever it is. So is there a difference between if I close personally title wise versus if I close through an LLC. And then we'll talk about the quit claim deed after that. Yeah,
you know my feelings on quit claim deed.
Yeah.
Okay. So yeah, there's just one big difference. So if you buy a property as an individual, you then, depending on the property, if it qualifies, you can get an expanded or an extended policy. Some people call it EAGLE. Every underwriter has their own name for this expansion, but it's a much better policy and it covers a lot more things like fraud, forgery, city certifications. Did they finish a property without a permit? Things like that. Okay. And that, especially for an investment property, any property really, especially with fraud going on right now, with seller impersonation happening right now, that is a coverage you do not want to not have.
Correct.
When you buy in an LLC or an S Corp or whatever, however you buy, you're not able to get that type of policy, type of owner's policy. You are going to get a basic policy, which is going to have the standard exceptions of boundary line for surveys, of any mechanics liens, right? That are not recorded, that are out there. Someone's owed money somewhere. Parties in possession, not of record, right? So there's a quit claim deed under someone's pillow. I mean, and you laugh at that stuff, but I've seen it.
I was going to say, yeah.
Yeah.
There's a lot of it.
So it's not just investment property. You're right. That's anybody's property. If you're able to get an expanded title policy, I strongly suggest it, especially in the era we're at right now with all the fraud and forgery and seller impersonation, because those items can be covered on that expanded policy.
Gotcha. So
What are you, when you say the expanded policy, price wise over the standard, is it a lot more?
No, it's usually between 15 and 20% of the premium.
Okay.
Which, I mean, high end, a couple $100.
Right. Yeah. It's a no-brainer.
Right.
Yeah,
and I'll give you an
absolutely a no-brainer.
example where someone could have used it. The owner of our company, their son-in-law actually bought a home and he got a basic title policy. Well, guess what? He wasn't there very long because before he was notified by the municipality that the seller before him did not pull permits on work that was done in the house. And it cost him tens of thousands of dollars because it had to be redone. It had to be inspected.
Yes.
And that's just so the $150 or $200 is
That
better
would've-
than tens of thousands.
that would have covered it.
Exactly.
If they would've done
And with
that
seller impersonation, we just had an event at our office. Luckily, we have a lot of different, protocols in place to thwart things like that. But we had closed the buyer and had their money in our file. And it was a great agent locally, and he had gotten from a referral, it was someone that had just pretended to be the seller on a certain piece of vacant land and would not verify their identification the way we needed it. So right away, red flag. And sure enough, it was a 23-year-old in North Carolina instead of the property owner here in Michigan, right? So thank goodness, because that would have been a significant loss.
Absolutely.
But that's happening all over at a title company near you.
Yeah,
So
and we're not even
unfortunately-
talking about wire fraud too, which is
Right.
totally different.
No, and I will tell you guys, so I
That's
do
scary.
expert opinion work throughout the country. I'm not in Michigan, but that is my topic because it is so prevalent. It is now in the billions of dollars of loss. And it's really hard. Seller impersonation is hard to thwart, and the buyer sending their closing funds is one of the hardest for anybody to thwart because they have all the information. They've gotten into somebody, they've gotten into the realtor's email or the title company's email or even the buyer's email in some cases. I have one like that right now. And they attack the buyer. Buyers aren't aware. And you can tell a buyer 50 times, please, we're not going to send you buyer instructions or please verify or please call. But they're so nerved up about getting their wires
getting the
and get to the
house.
closing table that they don't think. And that's actually the biggest wire theft happening right now outside of seller impersonation.
Yeah. So just real quick for our listeners, so they can really track what's happening, is what's happening is scammers, if you will, are hacking in, or essentially they're sending a false email or an email or getting a hold of the buyers to say, send your down payment, your cash to close money to this.
Absolutely.
To
And
this
they make
wire.
it look. So they usually hack in. Well, what they'll do, they'll hack usually with a link. Okay.
Yes.
And someone, it could be anyone in, whether it's a title company or a real estate office or even the buyer, if they're like, if there's they have a company as well. And so they get in and they watch all the emails going back and forth.
Yep.
So they can see the purchase agreement. They can see the closing package. They know when it's closing, what time. They know how much the buyer needs to bring exactly to the penny. And the buyer knows that. So they think it's whoever they're supposed to be communicating with. They have all the exact details, but they strike about 48 hours before the closing saying, hey, by the way, please kindly get your money in early so that you don't have any delays because you got this.
Right.
And they race to get that money in without verifying.
Yep.
And it's gone.
They send them wrong wire information or, for the scammers.
They'll doctor
correct,
up.
over this.
They'll doctor up
Yep.
the title company's wiring instructions.
And, with a wire, as soon as you hit the go button, there's no Control Z. There's no reverse Uno.
No, and unfortunately, unless it's over $1 million or part of a larger scheme, the FBI can't get involved. They just don't have the time. So you're pretty much out of luck unless it's part of a larger scheme.
Yeah, which is
It's
wild.
really, and I don't even like those cases, but I have to look at and say, okay, what could have been done differently? And it's not always where the compromise is, by the way. So let's say, Charlie, your real estate company gets hacked, or you were compromised and you were the source of compromise. It's not always going to be you that's going to be held responsible. Right now, the precedent in our country is who was in the best position to prevent the theft. So sometimes it's you because you clicked on, but sometimes it's a title company. Sometimes it's the buyer. He's the one pressing the final button,
Right.
or she. So we don't know at the end of the day. And realtors, there's already standing out there that the first case that went where it was a realtor's email that had been hacked, they unfortunately were responsible for 85% of the loss.
Wow.
So that's a lot of transactions you have to close.
Yeah, which is crazy because, how many realtors do we know have Gmail,
Oh,
Yahoo,
and they know I teach that. I teach a lot of
MSN,
cybersecurity.
whatever it may be.
And it takes, you can do a $5 Google security and it's not going to save you, but at least you show an effort to protect the data, right? You have to show an effort to protect this data. Right. And it's become, this is the most serious problem in our industry other than seller impersonation.
And this is where me as a real estate agent that I really, we can't say, okay, you're going with this title company. That they have options, right?
Correct.
But there's a lot of communications with my buyers and sellers, but with my buyers. And I will have them tell me, hey, let me know when you receive something, so I can confirm that the title company is sending it. And this is where, I'm communicating with Amanda, or I'm communicating with Carol or one of the transaction coordinators with the title, just making sure that we're doing our best to make sure that the fraud doesn't occur, because it's so prevalent.
It is.
It is so bad.
Yeah.
And you're right. And so for your viewers, I just, and yourselves in your industry, you're in lending, you're in real estate, ask the questions from those that are dispersing these files, right? Do you have portal? Do you have double encrypted portals? How are you protecting your information? How are your laptops or your computer? This is really important stuff. No one can afford to just be emailing wiring instructions anymore. It's unsafe because someone's money is going to get stolen. And whether it's not your fault or it's not your fault, it doesn't matter, because when a lawsuit comes around, everybody gets called in. And it's going to cost you time and money to defend yourself.
Right.
So but you have the right to ask the title companies, hey, what are you doing for security? Like, how is my client's information, because that's just as important as their money, or their money being protected? What's your process? Vital. And if it's just the listeners out there for your own transaction, you have the right as well to ask those questions.
Yeah. So going back to closing an entity or closing on a personal level, because a lot of people would say, I'm just going to quit claim deed it over to, my LLC or whatever it may be. Yeah. Outside of not having the expanded policy,
it's a big problem.
Okay.
It could be a big problem.
Okay.
So I'm not like the naysayer or the doom and gloomer. However, So if you close Reggie Osborn individual,
Yeah.
right? And you close like that. And then you decide to put it into ABC Mortgage LLC, whatever it is.
Yeah.
You've now changed the insured on your existing title policy, which your policy could be nullified. So now the policy that you had when you closed is no longer good. So I'm not saying you can't do that. I'm saying before you do that, call the title company that issued your policy
Interesting.
or the underwriter to see if by doing that, and then a lot of times they'll do an endorsement to that policy to change it, but you have to have the endorsement, right? And you also have to make sure that Reggie Osborn is the main member
of that LLC,
of that
S corp or
entity.
whatever it is.
Absolutely, yeah. It can't be family members. It can't be you've got to be So please, quit claim deeds drive me nuts. Well, everyone thinks they're quick claim deeds because you can just do them up quick. And I will tell you, quick claim deeds is like my nemesis because whenever there's a major title and problem, there's usually someone prepared their own quick claim deed and did something they never intended to do, but the consequence was they didn't know how to do it, but they wanted to save money of someone preparing one. So I strongly suggest everyone out there to please do not prepare your own quit claim deeds.
Yeah.
Because they carry a punch and you could do something inadvertently that now you're going to have to go to court to fix where you didn't have to before.
Yeah.
Well, and I'll bring that up really quick. And this was on a personal situation that happened when I got a divorce 11 years ago. We had a lot of properties and we trusted the divorce attorneys to write up the quit claim deeds for all of the rental properties for the splits. So then when it was time where we were selling them, when she was selling hers and I was selling mine, there were two properties on her end and there were 3 on my end that the document was not completed properly. So then I had to get a new document completed. And then hopefully you're getting along with that person that you can say, hey, can I meet you with a notary and us get that signed? This is where what you're talking about, not doing it yourself, paying a real estate attorney, making sure that these deeds are done properly.
Properly. Because
Absolutely.
now, and what happened if one of you had passed away? So now you have a bigger problem because you're divorced. Now, who are her heirs? Maybe she doesn't have heirs. Now you're going to be dealing with ex-in-laws to try to get that. I mean, it gets ugly quick.
It could have been very ugly, and it wasn't.
So if you're closing in an LLC, are there different documents? Like what documents would somebody need to show, hey, I am the owner
So
of this?
with an LLC, and I'm glad you asked me that question because so many people think, oh, it's my property. Once you transfer it into your LLC, it's no longer your property.
Yeah.
Okay. And you can sign for the LLC, but you can't get paid. Right. So Reggie, again, it's your LLC. When we go to close, Reggie's not getting the proceeds. The LLC is getting the proceeds. But in order to close, 2 different things. Number one, we have to make sure that the LLC is in good standing with the state of Michigan.
Yes.
Okay. We just do. Or the state of Florida, wherever you're at,
Yeah.
they've got to be in good standing. So that's something we check to make sure it's not dissolved. One of the worst things you can do is dissolve an LLC while you're still holding property into it. Then you're headed right to court for that usually.
That's messy.
But the other thing, what we're really going to need is a copy of your operating agreement because the operating agreement tells us what that LLC is and who can do what and who the members are. If there's more than, a lot of times it's single member, easiest for me. But sometimes it's multiple member. What are their roles? Who can sign? Can only one sign? Does everyone have to sign? And a lot of time we just do a resolution once we see that. And especially with a single member, we'll just say that, Charlie has the right to sign for Charlie for this LLC because we've reviewed the operating agreement. Gotcha. So those are the 2 things, making sure that you are legal with the state and good standing. And that means filing your, report every year for $25. And then a copy of that operating agreement. And you'd be amazed at the people that did their LLC and never put an operating agreement together. But you need one because how is your LLC run?
Well, and
who can do what?
Another needing that operating agreement. I mean, when you go to sell that property, they're going to give you a check, or there's going to be either a wire or a transfer. You're not going to be able. You're going to have a bank account in that LLC's name. Otherwise, you're going to show up to your bank to put it in the account. No. You have to have a business account
in the LLC's name.
LLC's name. Yes.
Yep.
People don't realize. I mean, first, like you put it into your trust. Same thing. It's your trust. It could say the Carol A. Mincy Trust. Doesn't matter. I'm not the trust. I'm an individual. So about 75% of people that have put into trust or an LLC have never opened a bank account in that, and they're surprised and they're like, "Oh my goodness!" So we can't give money to someone that doesn't own the property.
Correct.
So, and that's something I would really love everyone to know. If you have an LLC or a trust and your property's in it, open a bank account before you close.
Yeah, I mean, especially when you're talking about, let's say you're buying a property that, your grandparents or somebody's grandparents own and operated, they put it in an LLC or any trust, and now they've passed, and now the grandkids are trying to sell it or whatever it may be. There's a lot of different layers in there.
Absolutely.
From a title perspective.
Oh, absolutely. And that's what I'm saying. I'm the fixer. So I actually have, I find people all the time. Sometimes I'm like, I think they're dead. I kill people and they're not dead. But that's really important and also how you take title.
Yes.
You talk not just about the LLCs or the trusts, but when you take title, the words at the end of the buyer's names. If it's husband and wife, great. That's tenants by the entirety. One person dies, the other one full sole owner.
Yep.
Joint tenants, wonderful.
Same thing.
Yep. Joint tenants with full rights or survivorship, a little bit different. If you own property with someone as joint tenants with full rights or survivorship, and you have a falling out and you're angry and you move out, you cannot force that other person to sell, and you can't sell your piece of it until the other person agrees to it. But attorneys love to put joint tenants with full rights or survivorship, but the one that gets you is the tenants in common. And also, if you have no vesting in the state of Michigan, it automatically defaults to tenants in common. And that means, Charlie, if you and I own property, you own your half, I own my half. Okay? Well, what happens if I die? Well, if I die, you don't get my half. It's going to be my heirs and assigns again.
Correct.
Well, who are they? And what if they don't want to work with you?
What a mess.
So it is a mess.
It's a mess.
It is a mess.
Yes. So I think the biggest thing behind all of this is be able to communicate clearly with your title company, your title rep, to say, okay, this is what I want to do. Educate me on the different ways to hold title. Do I want to close in my LLC? Do I need to open my LLC? What documents do I need, or an S corp, or whatever it may be? What are the pros and the cons? Making sure when you're evaluating a property and you do pre-title work to see, okay, what does that title work look like?
Right.
Is it owned by an LLC? Are those people still with us? Or is it owned by an individual where it's somebody's primary home? Or there's a lot of moving parts there.
Absolutely. And, I work with, of course, a lot of realtors, and, they have to be careful for who signs a listing agreement too. Because if the property's in a trust, you can't sign as an individual. You have to sign as a trustee. Or if someone has died, if the probate hasn't been done, who signs for the dead person if they were the only one in title? No one can until the court appoints a personal representative. Yep. There's so many different pieces to this. I could go on and on.
And I know I've had deals held up because it's in probate.
Absolutely.
Yes. They had to go through it, and we're waiting on a court. So
absolutely.
We can't close on anything.
And for the agents, remember, a lot of times they don't know how title's held. So they go out and they get the listing agreement, and they're like, okay, my mom died, so we want to put the house up for sale. Great. The kids sign the listing agreement. Property goes up for sale. Then we find out, mom was the only one in title and she's gone. Well, that listing agreement's no good.
Correct.
Because
they didn't have the authority.
They didn't have the authority to sign it. And then they could say, you know what, too bad. Sorry, we're walking. Same with the purchase agreement. Same with the purchase agreement. It's not valid if it's signed by someone that's not authorized as the owner of the property to sign it.
And so this is the research too. This is where the realtor should be doing the research, should be asking those questions.
Absolutely.
If there's any question at all, I've said it for years with Amanda and now with you. If I have any question at all, I'm sending this information off to you both.
Absolutely.
And you're looking into this as I'm getting ready to get this going. I love to be able, before it goes live, we've already got pre-title already done.
Absolutely.
Which helps everything out, just flow smoothly.
I'm a firm believer in pre-title, especially right now when houses are selling pretty quickly.
Can you describe just real quick to people what is pre-title?
Okay.
What do you mean by that?
So pre-title. So when a title commitment, which is a title commitment is a commitment to issue a policy.
Correct.
Once all these requirements have been met,
Right.
and the premium's been paid. Okay, that's just an insurance insurance process. But what that commitment is, so in America, in American Land Title Association, the requirement is to go back 40 years. You get a good chain of title. We don't just look and see, okay, who is the owner of the property? Hopefully it's the person you're dealing with. Not always, but hopefully it is. But then we're also going to look, are there any encumbrances? Are there open mortgages? Could there be a lawsuit? Does someone owe taxes, whether it's state or federal or local? Any of those things are going to be listed, as well as whatever is now recorded against the property, like any kind of easements or right-of-ways, is going to be accepted. So we prepare a title commitment, right? Well, a pre-title is the same thing as the title commitment. It's just there's no buyer yet, but it will give you a full description of what's on that property. Now, for sellers, it's important to look at Schedule B, which is requirements, right? Requirements are pay off your mortgage. You need a quitclaim deed or a divorce decree or whatever the situation is that we see in order to issue a policy.
Right.
But for the buyer, if you're the buyer out there, it's the exceptions page. That's Schedule B2. And those are all the things that either limit or restrict the use of the property in any way, or give someone else a benefit to the property that you want to make sure you're okay with. Because if you're could be building restrictions that says you can't have an animal or a barn or things like that.
Yep.
Or it could be a right of way where someone's walking right along the side of your house to be able to get to the lake. It could be anything.
Yeah.
But that's
you
what
can't
a pre.
put your raised garden there,
Right.
Because that's how they get to the lake. Or
Exactly,
that's how they get
and you
to
can't
whatever
because
it may
the
be.
easement. You're the servient
Right.
tenant. So the reason why pre is so important is, what if there's a big glaring title issue, right? What if there's a lawsuit happening on the property? What if someone's entitled that's not your seller? I mean, so many things could be there. And if you do a pre-title, now you've got a little more time to clean that title issue up, with the help of your
Absolutely.
title company. And then be ready for when you have that sale so it doesn't delay a sale.
Yeah, and this is exactly why, Carol, we wanted you to come on, because not only do you need to do due diligence as an investor or as a buyer or whatever on the numbers of the property, right? To make sure, hey, can we afford it? What is the cash to close? What is the monthly payment going to be? What is the rent roll? What do those numbers look like? Not only do we need a numbers due diligence, we need to look at the property due diligence there as well. What is the roof like? The HVAC system? What is the plumbing like? Everything else.
Have
with
they pulled permits?
Yeah.
What's the municipality saying? Are they restricting
and then we need
anything?
to do the title due diligence part too.
Absolutely.
So that is absolutely vital, because you can think, hey, sweet, I got this property, we're going to do this. You've had inspectors out, you've done appraisal. You're not getting that money back.
No.
So
and it's gonna be expensive. My favorite saying is, title insurance is not sexy, but it is a very vital part of a real estate transaction.
100%.
Whether it's residential, whether it's commercial, whether it's investment, it doesn't matter. I would never buy a piece of property without title insurance. Never.
Perfect.
I mean, tax sale properties, that's another story. You don't get title insurance. You better hope it's clean, or you're going to be having all kinds of fun with that as well. So,
Reggie, I want to pause for our sponsors, and
Yeah.
then I want to get back into something else. So let's pause for our sponsors.
We're going to take a quick pause for our sponsor, Valor Collective. For years, your life has been defined by the badge, the uniform, and the heavy lifting that happens beyond the four walls. You've stood the watch and held the line. But what happens when the shift is finally over? Valor Collective presents From the Badge to the Beach. They've built a nationwide network of elite agents who specialize in helping the heroes community find their version of paradise. Whether it's a coastal retreat, a mountain sanctuary, or just a quiet piece of land far from the sirens and the stress, they are the bridge to your next chapter. They understand that after a career of service, you aren't just looking for a house, you're looking for the peace you've earned. When you're ready to transition from the front lines to the shoreline, there is only one place to go, onerealmove.com. No matter where you're looking to plant your flag, Valor Collective has the recon and the reach to get you there. OneRealMove.com. From the badge to the beach, because you've protected our world. Now it's time to enjoy yours.
Welcome back. So we're moving through, but when you were sitting and talking about this, a deal came up in pre-title, and it was about a year and a half ago, maybe a little bit longer, and it was in August, a couple of years ago, and this was a referral. I went out there, had everything set up to go to put it up. We planned, okay, we're going to put it up in 2 Fridays from now. So I sent the information to the title company. On the Monday before we went live before we went coming soon on Wednesday, I got a call from the title company. There is a problem. These people bought this property from the farmer. And the farmer had it in 2 different parcels. Well, the title company, I don't know who made the mistake. Was it the title company who made the mistake? But the back 2 acres that had the pole barn by the owners, they put it on after they bought it. Those back 2 acres were still in the farmer's name. I don't know why they allowed them. They didn't catch it back 37 years ago, but they allowed them to put the pole barn on this property, and it was still in
the farmer's name.
So that came back. That was a problem. It took.
That is a problem.
It took 3 months.
Confirmed.
It took 3 months.
And you're lucky that someone able to work with you with the actual.
The good thing was, so this was really bad because at the time the farmers had passed away, but the son owned it, and the son and the farmer son and the owners of this property were not getting along.
Of course.
Well, we needed papers to get signed.
Yes.
And so luckily the county and the township helped move the process, but then I had to schmooze the farmer's son, and I had to meet him at a UPS store because he was not meeting with the owner.
Absolutely.
But this was a mistake that was made 37 years ago, that if I would have gotten an offer, if we would have put it up for sale and got an offer, we would have lost that deal.
Exactly.
And this way, we didn't have to put it up for sale. I took it off. We weren't waiting 3 months. Yes. Bad.
I do that on a regular basis.
It's so bad.
I've been at Cracker Barrel sitting in the front, signing.
I'd rather go to Cracker Barrel than UPS.
Signing
Uncle
deeds on the
Herschel's.
hood of cars because some people are like, no, I'm not going to do anything.
Yeah.
Or how much are you going to pay me? That is the big, that's what
and what are you going to do?
Yeah. I mean, at the end of the day, you need it to be fixed. Yeah.
Yes.
It's because then it becomes a lawsuit, and it's a very expensive to be involved in a real estate lawsuit.
This could have been bad.
You were almost describing a country song there for a second. If it would have been the farmer's daughter instead of the farmer's son.
Yes.
The farmer's son. That's
so, Carol, let's say somebody's listening to this right now and they're like, okay, I want to build a real estate portfolio, whether it's a single family home, a duplex, triplex, quad, or more. What is one thing from a title perspective that you would just really say, hey, you need to avoid these issues or watch out for this pitfall because this is one of the most common things?
So I will tell you, and it's going to sound so basic, but I see it on a regular basis. First of all, I see so many times where people do exchanges where you accept a quitclaim deed from the seller and you exchange it for a cashier's check. So the title hasn't been checked. We don't know what's outstanding. We don't even know if the person you're giving the check to owns the property. And I know you're thinking, oh, does that happen? It happens all the time.
Jeez, oh, Pete.
And on top of that, not getting a title policy. And this is not because I'm in the title industry. I believe so strongly in this because people think, oh, you never pay claims. Title companies pay claims all of the time, right? But if you as an investor are not using a title company that's checking things out for you, and the seller's not giving you, because in most cases, the seller actually is the one that will pay for your owner's policy of title insurance, right? Because they have to not just say, hey, I've got good title. They're ensuring they're giving you good, clear and marketable title, which is very important for the value of the property. You know, like we talked about tax sales. People buy them, you don't get title insurance. It's like, good luck. But guess what? If you can't get title insurance on that, it's not even going to be worth what you pay.
Correct.
It might be worth $500. No one's going to pay you anything because the value is in being able to get title insurance, because you can't mortgage something that can't get title insurance. Nope. You can, you know, it's nope. worth not nearly as much without it. So for me, we buy investment properties, and I have yet once, you know, and you will have sellers say, well, why do we use a title company? Because they don't want to, you know, pay for title insurance or close it, whatever it is. But I will tell you, and sometimes we've paid for our own title policy because it's that important, and it has saved us more times than not.
Yeah.
So that's the big
because ultimately, let's say this person buys a property, they choose not to have title insurance.
Happens all the time.
Now, when they buy that house, somebody comes knocking saying, hey, we put a new roof on 10 years ago, and it was $15,000. Now, can they go after the old sellers, or is that your responsibility now as the owner of the house? As the
owner of the house, their problems become your problems.
Exactly.
Can they sue the seller? Yeah, but did the seller give them a quitclaim deed? Because remember, there's a difference between a quitclaim deed and a warranty deed.
Right.
If you're listening out there, a warranty deed is what you want, because the seller is warranting to you that during the time they owned it, they didn't do anything that could create another interest or an encumbrance on it.
Right.
Super, super important.
Yeah.
I can give you a great, really quick story, and it had to do with a local property, and the gentleman did not want to use a title company. Just didn't want to use a title company, and he bought this property from a woman, and she signed it, giving him the property. He had no problem. He bought an online contract and then paid it off and got a deed from her, which is great. Unfortunately, though, when we got the purchase, when he went to sell the property, yes, she deeded the property to him, but she didn't own it alone. Her 3 other siblings owned it with her, and she sold it out from under them.
Oh, boy.
So then comes the trying to find out. They're all dead. Okay? They're all dead. But luckily, one of them, there were 2 priests and a nun, but one of them had children. So it was finding the children of one of the surviving siblings.
Oh, my goodness.
To have them. And it was affidavits of heirship. It was quitclaim deeds it was about a 9-month fix. But I will tell you guys, not everybody's going to take that time to do that work. But that's a great example. And the owner that was selling was furious because he said, well, I paid them money. But you know what? Guess what? You didn't know that 3 other people own that property.
Yeah.
And it's not just a matter of, it's been so long, because that's 75% of ownership. A judge is going to have a hard time doing quiet title where 75% of the owners didn't sign. I'm not saying they won't. It depends on the judge, but it's going to be a little tougher.
Yes.
Yeah.
So.
Wow. That's wild. And that's the importance of title insurance, and absolutely why we wanted to have you on.
And like you mentioned, I had to talk all 3 of those siblings, those children, and they were furious. Their aunt screwed the rest of their family out of that money.
Right.
They were furious, but God love them. It took them 3 days to think about it, and they called back and said, okay, I had to drive up north, but it was worth it to do it, to get that property to close.
A good excuse to go up north too.
Yes, always. Yes, absolutely.
So let's look at a deal. Last time we did that, I think we had a great time looking at it.
Yes.
So Charlie, what are we looking at today?
So, we've been trying to find a real good deal. We've been talking about it all week.
Yeah.
And you found this deal. It's in Oakland County. Obviously, we're not bringing up the addresses or the cities or anything like that. But this is I would say it's a 3-plex, right? It's 2 3-bedroom flats, and then the basement has a studio. And the asking price is $499. I spoke with the realtor today, and once again, I love when I ask the realtors, where did you come up with this price?
Yeah.
Like, I always love asking that. Like, where did you come up with this price? And so usually when you have these rental properties, you have some type of rent roll that you can present. Well, a lot of times they won't have it on the disclosures initially. We as agents, we have to call and have them send the rent rolls, show us the documentation of, hey, here's the NOI. This is everything that's going on in the property. What's coming in? What are the costs? what does it cost to run this property? When I called and talked to her, she explained it was an older gentleman. We don't have any of that. He decided to kick everybody out of the house and put the house up for sale. So there's no rental income coming in. That being said, in the area, what he was bringing was about $4,500 a month. Now, keep in mind, and we see it all the time. I mean, I told you a couple of weeks ago, the property that I have here in Brighton, I mean, they were renting the upstairs unit for $175 a month in downtown Brighton for a 1-bedroom unit. And they had been renting it to him for 10 years.
Oh, my goodness.
I mean,
darn it.
Carol's like, I could use that as a little
Yes,
studio
my
getaway.
gosh.
the 2-bedroom unit downstairs, they were renting for $650 a month.
Oh, my.
I mean, and so when you look at the rent that he's getting, I had ran the numbers, and it's, the average 3-bedroom or the average 2-bedroom units, they're getting about $2,200 to $2,300 a month.
Wow.
Okay.
But he's getting $1,750 a month per those units. And then you have the downstairs studio, which, I mean, the numbers are saying that it might be $950 to $1,250 a month for those units. One of the things that I say about this that always sticks out whenever, I have clients call and say, look at this property, look at the taxes. Reggie, we talk about this all the time. This gentleman has owned this property for a very, very long time.
Uncapping.
And he is currently spending about $3,500 a month in taxes.
Oh.
If we keep it that way, it'd be all right.
So,
Wow.
so in just bringing this up a little bit, I had went on, and I talk about it all the time with my clients whenever they ask, well, what are the new taxes going to be? I said, it's really easy to sort of get a decent number. You go on the property tax estimator from the state of Michigan, put in the city, put in the county, city, and the school district, and it gives you
everything.
It gives you sort of where the taxes are going to be. So when I ran the taxes on this property, Reggie, the non-homestead goes up to $14,000.
From $3,500 to $14,000.
Yes.
Yep.
Oh.
Yes.
Yeah.
That's a jump.
And that's a year?
That's a year.
That's a year.
But when we look at the numbers, initially you think, wow, we could raise some rent. This could be really good. And then we look at the taxes that are going to go up. And now we have to talk about things, right?
Yeah.
Like where are we at? So one other thing before you dive into it, the immediate thing that I see is whoever gets into this property, rent. First of all, there's nobody in it, so rent's got to go up.
Yep.
Period. So that's where I'm at on this property. I don't know. I think that the property's been up a little over a week. I believe that the numbers, it could be a little bit less. We might be able to get it a little bit less. But where'd you come out? So where'd you come out on the money side?
Yeah. So if we're looking at this and we're just running basically everything off of full asking price, right?
Right.
Just at $499.
Yes.
Okay. So if you do 20% down with a DSCR loan, you're going to need about $118,000 at closing, and that's your down payment, setting up your escrow, your appraisal, title, everything, transfer taxes, all that stuff. Everything, all up, all in, is about $118,000. Your loan amount's going to be just under $400,000. So your monthly mortgage, your PITI, which is your principal, interest, taxes, and insurance, is going to be just under $4,100. Now, you look at that and you're like, oh, okay, well, I'm collecting $4,500 and, I only owe $4,000. That's, almost, or $4,100. It's a $400 to the positive. Well, yes and no, right? Because you've got to save some. And I know you're cringing big time.
I know.
Because, we always look at it from a 75% rule.
Yes. Mm-hmm.
So if we look at the rent, take that times the projected rent, right? At $4,500 times 75%, that's only $3,300. Now we look at that compared to the $4,000 that you're paying in the mortgage, and we're losing about $700 per month here.
Yeah.
So
Correct.
The biggest culprit, obviously, is the taxes.
Yes.
Because again, they go from, let's see here, your taxes went up to $1,100. They went from basically $300 a month to almost $1,200 a month. Wow. So all
And that
of
doesn't
that
even,
profit.
does that include maintenance or when something breaks or?
No, and so this is where
Insurance.
sometimes when I look at this, even for on the sell side, right? Like this is where the agent, it's the agent's responsibility to have these numbers and be able to come and say when a buyer's agent calls and says, listen, I understand the rent's low, but let me show you, create a document to say, let me show you what the rent is in the area, what they can get for it. Because once we start showing those numbers, Reggie, we talk about it. I mean, the deficit is how much was it? $719.
Yep.
You're losing $719. But let's bring this in. Let's talk about this. So when we look at this, the initial numbers, it's a boop boop.
Yeah.
No, not happening, right?
Yeah.
So let's just say that $1,750. Let's just say we bring in an extra $500 a month total, which we probably will bring in more. Does that make this look a little bit better?
I mean, it could, and a lot of this is going to depend, right? A $200 a month net loss, and at 75%. So we're using very conservative numbers
Right.
here.
Okay.
So you could still be cash flow positive for sure, but then again, what is the HVAC life looking like?
Roof.
What does the roof life look like? What is the sewer looking like? What are the pipes on the inside?
Appliances starting to go.
The appliances.
Plumbing.
What is the electrical look
And
like?
they don't even have in here, when I asked her for the numbers, we don't even know what it's costing to mow the lawn, what it's costing
Just the
to
maintenance.
plow the driveway, what it's costing for all the minimum maintenance that you're going to have. And so we have to, this is where, like I say, this is where we come into play and looking at these numbers and making sure, okay, is this a good property to get into?
I mean, to me, if you're looking at a green light, yellow light, red light, to me, this is definitely not a green light situation.
Correct.
Where it's just like, oh, this is a no-brainer, yes. I don't think it's a definite red light either, though.
No,
where
absolutely
it's just
not.
like,
Yeah.
no, let's just keep the train moving down the road. Let's find
Right.
something else. I think this is a good yellow light, maybe orangish, where it's leaning a little red just because of the cash flow. But maybe it's in a good area. It's in a up and coming area, and things are appreciating around there. Maybe
And building up around there,
Right.
like new construction, or they're bringing in new
Once again,
stores
location.
Yeah, always.
And I will tell you that this property is in a good location.
Yeah, it actually
So
is. Yeah.
now you're right. Now that gets that a little bit more away from the red and gets it a little bit more to the green. We're still yellow here.
Yeah.
We're still orange, right?
Because you've
But
got to do your due diligence,
yes,
right?
you have to absolutely.
Well, and are you going to have to upgrade? Is it
True.
older?
I mean, if he's been comfortable sitting there collecting that little bit of money, yes,
probably needs updates.
it
I
probably,
mean, maybe the wood panel that was in the,
is
the
it again?
70s and 80s
The
is back
retro.
again.
The retro's back.
yes, and
Absolutely.
so once again, we're having to come up with $118,000
Yeah.
to close. We probably need to. This is where we're getting out there during the initial showing, doing a second showing to look at it again, then with the inspections to really have things figured out. Okay, is this right? Is this a good deal?
Yeah, I mean, because if you were to look at this from an NOI standpoint, from a cash on cash return standpoint, this is a red light all the way around.
Correct.
Right. I mean, your NOI has got to be in the fives, I think is what we were. What wasn't it? I can't remember.
I mean, the cap rate on it was already like a 5.1.
The cap rate was,
Yeah.
I'm sorry.
Yeah. The cap rate was at a 5-point run. And, once again, that's with no mortgage.
Yeah.
Right.
Oh.
So it really is, man, it's tough here. This one's a tough one. But that being said, Carol, for somebody that wants to get into this in a 1031 exchange.
Well, because if they're not going to have to come up with 118,000, they're just going to be transferring that part over. It depends.
It
I mean, you
depends.
still
It
have
still
all those
depends.
other variables.
Yes.
And we haven't even looked at the title work yet to
No.
see what's going on. Because just because someone has owned it for a long period of time does not mean that there's something
That is spotless, clean.
Right. There might be something lurking there that may be a
Happened
problem.
37, 40, 50. Yes. I mean,
And
what are we looking at this?
And if
this
it's
property was-
118, if I'm using a 1031 exchange, I mean, maybe then I can always decide, hey, I don't want to put all my money into a 1031 exchange. Maybe I do put the 118 in that
Yeah.
property and then take, possession of the rest of it. It's going to be taxable, but I see people do that as well.
So with that, and thank you for bringing that up. So your only tax, let's say you netted 180.
Mm-hmm.
So you take 120, let's call it, and put it towards this at a 1031 exchange.
Yes.
You would be taxed on the 60.
Yes.
That difference.
And it doesn't matter when you took it. So maybe you only put 120 in at the time of closing when you close on your the property that you're surrendering.
Yeah.
Your relinquished property is what they call it. So you can put the whole 180 in there. And then if you only use 120, they can also reimburse you at that next closing for the replacement property. But the minute you take any dollars, all the dollars you take personally is going to be taxable.
Gotcha.
Yep.
Let's pause one more time.
Today's episode is brought to you by Valor Collective. In the heroes community, among our military first responders and frontline workers, trust isn't just a word, it's a lifeline. It's earned through action and proven in the trenches. When you're ready to make a move, you don't just need a real estate agent. You need a team that operates by the same code you live by. Valor Collective was built on that foundation of integrity and grit. They understand that for you, a home isn't just a transaction. It's the rally point for your family and the one place you can finally decompress. They've got your back because they've walked the path. Valor Collective, built on honor, driven by results. Your move is our mission.
So, Reggie, what is the final verdict? What are you saying on this property?
I mean, on this one specifically, I would probably, all things being equal, I would probably say pass on it.
Okay.
For me, the investment that you're putting out there with the return that you're getting, I don't think the juice is worth the squeeze on this one personally.
Okay.
But I don't know. What are your thoughts, Charlie?
So, my thoughts on this are this is where I come into play for my clients, and we start looking at negotiating the price because I personally don't believe, once again, this is the common thing that I always ask when I call an agent. Where did you come up with that number? Like, did you just come up with it just out of your head, or did you actually put the calculations in there and do the research and go, okay, this is the rent that's coming in. It's a really simple calculator, a calculation to figure out this is the rent that's coming in. This is what what we can ask for the property. Well, I don't see that number, and that's what I asked her. And so I believe that it's still a yellow. With some good research and maybe some negotiations, but the taxes are, man. I mean, that's where
It's a big jump.
Yes, absolutely.
Do you want me to throw my 2 cents in as an
absolutely.
investor, not as the lender or the realtor? But we have bought quite a few investment properties. I am probably going to say for me it would be a red.
Okay.
And the reason it would be a red, and I haven't even seen the title work to know what's lurking around there, right?
Yeah.
Then that might be perfectly fine. But here are some of the things, definitely the taxes, because the taxes are just going to keep going up.
Correct.
Right? And yes, the rents will definitely, hopefully keep the pace with the tax increases. But, we've got an empty building. So it's going to take time to get tenants in there. Hopefully we can get them in there for the rent that we want. So if we already had tenants in there paying and they wanted to stay and we could gradually raise the rate and I felt comfortable that they were going to be good, strong tenants, I would change that to a yellow, maybe a yellowish green. But starting with just a building and nobody to rent it yet, for me, taking that money out of other investments
Right.
would probably be a no, unless we could reduce that price. You could work with me. We could reduce that price. We could see, maybe see what the look at the stats for, what the rental market is in
Correct.
that area,
Yes.
because that's huge.
Yes.
I had a sister that bought a rental house in an area where nobody was renting. And it took almost a year to get renters in. And that's a huge loss. That's a time
And
suck,
that's where the
and it costs you money.
research has to be done.
Yes.
And that's where I hear you both. Like from the initial, it's a run.
Yeah.
But for me, if we do a little bit of research, maybe.
Right.
But
and
this is definitely, this was that last week when we talked about those properties, they were definitely the one that was like, whoa.
Yeah.
Absolutely
No,
not.
yeah.
I don't think that, I hear you where it's definitely a red, but I think there could be something in here if there was movement.
Yes.
If
Right.
there was movement in the price, then maybe.
And
Yeah.
if you found that is a very, very rent heavy area, that it's a desirable area, that they're, people are battling each other to get into rentals,
Right.
that might change my mind as
Correct.
well.
Correct.
We do a lot of college rentals.
Yes.
So
Yep.
that's what I'm familiar with. And
Right.
those always, by the way, always rent out.
Yes, absolutely. Absolutely. So, Carol, anything else that you want to mention? I know we were talking a little bit off camera about the different things with title or something about the 1031 exchange.
Right. So
That-
it's the property that you're selling and the property that you're buying. You have to make sure both of those properties qualify in a 1031 exchange. If it's your primary, never, ever, ever. It's not for that purpose, and not even a place that you own up north. If it's like your vacation home and you go and stay in it, it really has to be true investment property. There are some stipulations that maybe if you're only up there a little bit, you've got to really understand and research, or have your agent research, or talk to
Right.
the intermediary, right? The qualified intermediary to research, because you got to make sure that you don't go through all this and then your properties don't qualify. And now this money's going to be taxable. So make sure not just the property you're relinquishing or selling, but the property or properties that you're replacing them with fit. They have to be investment and kind of a like kind, right? You can still go from a triplex or a duplex to an apartment building, but if it's a totally different kind of investment property, there might be some restrictions on it. So always make sure verify that the property you're selling and the property you're going to be acquiring fit that description of what the IRS will allow.
Yeah. No, obviously, if it's your primary home,
Never.
you don't have to worry about a 1031 exchange.
No.
Because
You've got
I
your
think
other
it's-
exemptions depending on what
Correct.
they are.
Correct.
And I will tell you, for those that don't know, do you know what those exemptions are?
Isn't it $250 for a single and $500 for
So
a
it's
couple?
$250 for a sales price for single.
Yes.
Yes.
But there's also caveats with that.
Okay.
So it's exempt if you owned and occupied it for
Correct.
2 years.
Correct.
Right? If you have not rented it. Okay.
Correct.
Okay.
Ding, ding,
Ding,
ding.
ding, ding. Yes. If you have not done a 1031 exchange on it at any time.
Right.
So those are the things that make it.
So when we
Not
talk about that, how do they calculate that 250? Because I believe it's from the purchase price to the sales price, correct?
So that's for capital gains figuring.
Yes.
So if that sales price is $251,000 and it's owned by one person, you don't have the exemption.
Correct.
It has to be $250,000 or less for a single owner.
Correct.
Married couple is $500.
Yes.
Or less. If it's 501, it doesn't qualify. And then at closing, the IRS is going to know, and you can't not answer. It's just one of those rules that you can't close if you don't answer this questionnaire from the IRS. And it explains, is this your property that you occupy? Did you occupy it 2 of the 5 years? Have you ever written it off for business? So if you have a home office in your basement and you've written off with the IRS, you're going to have to mark that you did that. And then I'm not saying that it's not an automatic exemption.
Right.
Now you've got to work with your CPA to figure out what, if any, capital gains are going to be owed.
Right.
Okay. And
Absolutely.
you were right about the capital gains, because they look at what you paid for the property, now what you're selling the property for, minus any improvements or anything that
Correct.
you made to the property, right?
Correct.
So So, and that is not something that any of us are going to decide. That's going to be your certified public accountant or your tax attorney.
Correct. And,
Right?
and we've had those instances because,
Correct.
especially over the last handful of years with housing appreciation going up in value, there's definitely areas that have seen market gains.
Oh, yeah.
And obviously, if you do improvements and stuff, you can add that in to that sales price.
It's significant.
The original purchase price.
And the
But-
capital gains can be extensive depending on the
Yes.
tax bracket you're
Yes,
in.
they
I mean,
can.
that's a significant amount of
Yes.
money. It truly
Absolutely.
is.
So, especially if you're selling the property, you want to be smart about it, right? You want to be very intentional. If you have an investment property and you're looking to sell it, you want to get with, obviously the realtor, with the title company to figure out what does it look like, and make sure that you're set up. So if, you're ready for that 1031 exchange, the moment, that home is sold, that clock is ticking.
You're ready to go.
And you've got to hit the ground running. So
Absolutely.
you've got to have all that pre-planned, ready to go,
Yes.
and a plan in place. And that way you're set up for success, and you're not like, oh man, we missed it by a day, or we missed it by a week.
And a day is you missed it.
Yeah.
I mean, there's no, we'll forgive you, or, what are some of the roadblocks? Maybe you can't get a mortgage in time for the replacement property.
Mm-hmm.
It happens because sometimes there's variables that take a longer time to get
Correct.
that. Maybe there's a municipality issue. There's so many things that can delay
Yes.
or
Yeah.
extend that
Or it's
timeline.
in probate.
That
Or it's in
180 days,
probate.
180 days goes quick.
Much quicker than
Quick.
people understand, or a title defect or a title issue, right? Somebody's got a lien on it. Now you got to find them, or an old mortgage that never got discharged,
Or a barn on a piece of property.
or a barn on a piece of property. Absolutely. So those are, so just be really cognizant. One of the things we do see though is we have people as they get older, they're like, okay, I'm tired of rentals, right? I just don't want to do any maintenance. I don't want to go running out for a drippy faucet. So they think, okay, I'm just going to sell it. And I don't want any more properties, but you can't use a 1031 exchange for that. Like if you're selling it and going to take the money, then the 1031 exchange is not for you. You're going to be taxed.
Right.
Yeah,
on
Uncle
those
Sam's going to
proceeds.
come knocking.
Yes, it is.
Absolutely, 100%. Yeah,
Absolutely.
absolutely.
Wow. What a day. It's been
Awesome.
absolutely
so
wonderful.
fun. It's been wonderful.
That is the investor blueprint in action.
Yeah.
Absolutely. And a big shout out, Carol. We appreciate you coming in and bringing 40 plus years of transactional experience
Aw, well,
to the
it's been a
show.
pleasure. It's been a pleasure.
It's wonderful.
So-
Anything
Awesome.
else?
And we've been great buddies, and I appreciate your friendship and your professionalism and your knowledge, and bringing it to us
Yes.
and bringing it to our viewers and everybody else. So
Absolutely.
I appreciate you.
Wonderful.
And, Charlie, it was another great episode. Great to look at a property and
Yes.
just dissect it.
Yes.
Because that's what we want. That's the common person that doesn't have a trust fund or doesn't know anything about investing. How do I get this started?
Correct.
And
Absolutely.
knowing that's why we want to have people like you, Carol, on here to talk about the title work, so people can know the common pitfalls and what to look for and learn some of the terminology. So go back, and because we covered a lot on this episode.
We did.
You probably have to go back and listen to it again.
Yes.
Again.
And
Well, and it's funny you bring that up because one of the things I do teach, and I actually teach at Brighton High School about investing, but on the real estate side of
yeah.
it. I was asked by one of our CPAs, he just retired. So, and these kids are all about it. Like these kids are like, okay, I want to invest my money. And one of the things I really try to explain to the youth is not everyone's born, with a silver spoon in their mouth. A lot of people are born where one of the best ways to build wealth is real property with
Yes.
real estate, because they're not making any more of it, right? And it's always a good investment.
Yes.
And so that's why I'm so thrilled you're having this podcast, because there's going to be a lot of people out there that say, you know what? I want to be able to build wealth. And this is, in my opinion, in this many decades, this is one of the best ways to build wealth.
Absolutely.
So good for you guys for doing this.
Yeah, and we've talked about that too, about, you buy a property for $500,000, you're leveraging $500,000 in market appreciation, as opposed to, if you put $120,000 in, you're not getting $500,000 worth of appreciation over the course of time. You're only working, like if you put it in the marketplace, you're only getting $120,000 worth of appreciation in the marketplace.
Absolutely.
Right? So it's
and
huge.
and how could you save? It's like we bought a house down in Florida and we decided we didn't want to stay in that house. We owned it. It was an investment house, but we were there, for a time being. But my goodness, I mean, we in 10 months, we paid $260 for it, and 10 months later, we sold it for $370, and we didn't do anything to it. It was just the market.
You're not making that in the stock market.
No, and that's what I'm saying for the younger people. We got a mortgage on it, right? Mm-hmm. We did these things, but wow. How hard is it to save $110,000 in a year? You know, especially if you're younger, or it's hard to save $110,000. So it's a great example of why real estate is so important.
Absolutely, Carol. Appreciate your time.
Thank you so much,
Thank
Carol.
you guys so
Reggie,
much.
Charlie, awesome.
Until next time.
Absolutely.
Have a great day.
Now, this show is brought to you by the Mortgage Cowboy. The mortgage industry has done an incredible job of making things more complicated than they need to be. Now, that complexity, it comes at a cost, and everyday people pay for it. Now, I built the Mortgage Cowboy brand around one simple idea: to give straight answers, no jargon, no runaround. Whether you're financing your first investment property or your fifth, my job is to make sure that you understand exactly what you qualify for and why. Whether it's DSCR loans, investment property financing, or creative solutions, my team and I, we have the ability to lend in almost every state. Check out reggieosborn.com or connect with me on all the social platforms, reggie.osborn. Now, as a reminder, the content of this podcast is for educational and informational purposes only and represents the personal opinions of the host. It's not intended as financial advice or legal advice or investment advice and should not be relied upon as such. Always consult with a licensed professional regarding your specific situation. Reggie Osborn, NMLS 1934542, Cornerstone First Financial, NMLS 173855, Equal Housing Lender. This is not a commitment to lend, not available in all states.